Good morning, everyone. Welcome to our Monday morning trading session, start of another trading week. I trust everyone had a nice weekend. Mine was short. I got too much going on the weekends. I just want a weekend where everybody leaves me alone. Oh well. Okay, so the markets just opened up. Let's take a look here at the Eagle, see what's been going on here at the NASDAQ. Looks like it's a fairly quiet open. The overnight, not very active. Of course, this would be Sunday morning, so we're not expecting the market to react all that much. And here we are starting the day more or less where we left off last week. We finished the session last week at around 43.24, opened a little bit up here, 43.34, made a quick little move lower. And now we're coming in with a red bar buy. And, you know, the Eagle is one of these tools that I will trust an early signal on, even though the trade forecaster says that we're in scalp mode, or pardon me, swing mode, going into scalp mode. If you're going to try this trade, I think it's important that you leave your stop as far back as possible. This is essentially a hard edge bounce. The market may also be in this larger trading range at the moment. So this is really a test the waters type trade. It is risky. It's only a minute or so since the open, and we're not entirely sure. The market doesn't have a whole lot of structure to it just yet. So please don't feel like you need to follow in that trade. Normally what I like to do is I like to let the market unwind for the first 15, 20 minutes, maybe even half an hour before committing to something. And yes, it's okay to do that. You don't have to rush into a trade. There's plenty of signals throughout the trading day. Don't ever feel like you have to hurry up and take a signal because you may miss a move. You may end up missing a move, but it's certainly not the end of the world. You'll always come back with another one. So here we are, the Falcon also producing a little bit of a trend change. The Raptor dead quiet here at the moment. If this Eagle bar finishes lower, I'm going to scrub the trade. So I'm just going to give it this one bar to come around. And I'm using the second push, or what I refer to as a second push entry. Namely, you allow the market to engage the signal. You see where the market flinches, because it almost always will. And then you place your entry above or below that point, as whatever the case may be. So what I'm hoping is, because out of the opening minutes, there's been such a struggle on this bar, and you see they slipped us a tick on the entry as well, that whatever side gains control of this bar, that's going to see the immediate short-term range for the market. That's the plan anyway. We'll see if we can't sneak one out of here. So I'm going to, hopefully we'll see the market advance here for a bar or two, at which time I'm going to become much more aggressive with my stop strategy. Trying to give them a little bit of breathing room here just to start the day. While that's going on, oh, no, we don't have the first micro-macro cross signal just yet. The Falcon did produce a trend change signal, however. So there is an opportunity here on the Falcon. Now, as this one was printing, you can see the hash mark is printing right on the high. I would probably give it one more tick, even though I know that if it fills on the hash mark, it's probably going to break by at least a tick. I don't know, it's just a habit. Okay, all I'm doing is simulating the Falcon trade. I would not recommend trying to get into a trade late like this. All I'm trying to do is simulate it for those of you who are in this Falcon trade. You can see we're keep hitting the primary resistance here, which is why you want your stop at least back below this prior swing. Ideally, even below this low would be better. One thing that I did incorrectly here, because it's so early, I would dial down the risk amount. I would only go in with a single. Very often, that first trade of the day, I don't want to over leverage myself. Even though this amount is an amount I can afford, I still just, testing the waters, seeing which way the market may be inclined to go today. For me personally, I'm normally a little bit more comfortable doing that on a single contract versus getting too heavily leveraged. Now gold, bring gold over here real quick. We haven't looked at gold very much, but we are getting a rule of three type signal in gold. Notice the high, notice the market coming down, hitting the hard edge, coming back up, testing the extreme, coming back down, and now producing two sell signals. Technically, this one was only a tick or two away from producing a signal. And the rule of three is just the loose name that we give this. Sometimes you only get two signals. And certainly you can use a second push on this one also. Or you can just use it as an early warning and hope that the market is going to give you a trend change signal, which it very often will. We got a corresponding signal in gold on the Falcon also. So here's gold now on the Falcon. And you can see we had this nice little trend change signal right here. So you could be short on your Falcon also. Okay, so a couple of options here this morning. The market contending with the current lows, these swing lows right here. But as I mentioned before, it's still very early. In fact, I may have mentioned this to you guys before as well, that very often when I'm doing my own trading, I don't get into the office until 7 o'clock, which would be 10 o'clock in the East. All right, working a first micro macro cross. So we're getting signals across the board now. This one I will remember to hit the single. So I'm just going to do that in the single. And what I'll do is if this order fills, I'm going to eliminate the profit target and see if we can't run it out a little bit. A little bit of buying pressure. They're trying. All right, so let me eliminate the profit target and the break even. I'm going to try to run this one out. Yes, William asks, good morning. So if we miss a trade and the market doubles back to the hash mark a few bars later, we should stay out? Normally, that's what I would recommend, yes. If I miss the initial rally of the trade. You see, the danger is that, especially here on a tool like the Hawk, let's say I missed the first micro macro cross. The market could rally up a little bit, hit the profit target, come back down, and now it's it's trading below the entry. You have a chance to get into that signal, but what happens if the market just trades up for a bar and then goes the wrong way? Right? So it's most obvious on the Hawk, because the Hawk is the scalping tool. You may get that initial move, your profit target may be there, the market's already reached its objective, it's come down. This is no longer a signal. Now, if the market comes down and, say, produces a macro pullback signal, and it just happens to be in the same neighborhood as your first micro macro cross, well, okay, that's an entirely different story. What I did here on the Falcon was just for demonstration purposes. The market went up, engaged the signal, came back down low enough that I could actually re-engage the order. I don't normally recommend that. Now, so far, it's plodding along. I may catch a little bit of a lucky break here. But normally what happens is the initial momentum off the signal will be the greatest. If you can't catch the move off the initial momentum, it's not going to help you very much to get into that signal if it happens to drift, if the market happens to drift below. Good morning, Jim. Jim says the advanced decline pretty lopsided for the buyers, considering that there's no real opening gap to speak of. 2,072 on the buy, 596 on the sell. So shy of 2,100 on the buy and just shy of 600 on the sell. We'll see whether or not that actually pulls us higher here. And oil, let's see here, give me a moment. Jim's watching the cloud to cloud on crude oil, and he says there's a huge cloud building on crude oil. So for you Raptor traders, what Jim's referring to is the big cloud here from the tip of one cloud to the tip of the other cloud. If this gets really wide, it tends to show you an overbought market. But don't forget, just like, you got your stochastics or your RSI or any of these tools that measure overbought, oversold scenarios, just because a market is overbought does not mean that it needs to reverse. In fact, I remember several oscillating strategies that recommended you buy when the market or when the indicator hit overbought. So the exact opposite of what you would expect from the indicator. Crude oil very strong this morning though. Certainly if we do get a soft edge sell signal here, and the soft edge sell must always be preceded by a test of the extreme. So a little failure like that, and then if the market came down with a soft edge sell signal, this would be your objective down here. But until we get that little failure, that little retest of the high, showing that the market has lost momentum, I don't think I'd be looking to short crude oil. Not yet. The longer term charts are showing crude oil to be quite bullish also. What I mean by the long-term charts, the daily chart. If you're day trading, then your daily chart is your long-term chart. All right, so we did manage to hit our profit objective on the Falcon trade. We also produced I don't know, I suppose you could call this a cloud crossover. The cloud just crossed over very so slightly here and came back. So we do have a raptor signal going also. You could just consider it a hard edge bounce if you wanted. And now the big deal is that we're back up against the overnight highs. I did say I was going to get more aggressive with my stop here as we gained a couple of bars. And now that we're getting a possible double top, I'm going to force the trade to break even and leave it at that. It may prove to be a little bit too soon, but what can I say? I don't want the market to back up and tag me for a huge amount. And I'm going to go with, I think, the parabolics here on the hawk, or where is the ATR at? Yeah, I'll do the ATR for now. It's sitting at break even. In fact, I'll give it break even +1. Make sure the broker gets paid. It's very important. Let's see if we can't run this eagle or hawk trade out a little bit. I'm getting my birds all confused. So now that we're through the primary resistance, next stop 43.44.5, and if we get through there 43.55.5. 43.50 I seem to remember was a little bit of an obstacle for us last week. As was 43.45, I believe. So expect the selling to get a little bit more aggressive as the market creeps a little higher. Yeah, like Jim says, the Geiger counter is a great reference. It is an amazing tool, the Geiger counter. Especially once you learn to watch the dial and you can see the buying and selling pressure. Look at the orders flowing through here on the NASDAQ. Was that just me, or were there 500 orders on the buy side? Look at that, 240, 244. Now, I don't think that's all spoofing. Spoofing means, and it's totally illegal, and none of us can do it. We're far too small to do it. But let me see if I can get a dome up here so that we can see. And I'm doing this just to show you. I don't believe you need to actually watch this sort of thing. Hold on, I'm having a little difficulty here with my dome. Okay, we hit our eagle target, so let's go here now to the, oh no, sorry, I was going to show you the Geiger counter. That's what I was doing. If I can get my act together here. Okay, so here's the dome, and all the dome shows us is the bid and the ask, and the Geiger counter shows us the bid and ask also. It shows us the next level. So the histogram kind of gives us the current, and then we get the bid and ask, which is the next level. So the first set of orders, higher or lower. What spoofing is when you see a huge amount of orders up here, like abnormally large. You're going to see that the orders tend to get a little bit bigger as prices get away from the market. So for instance, there's a lot more people looking to sell 43.42 than there are traders looking to sell 43.41. What spoofing is if all of a sudden you see a huge abnormally large number, let's say like 500, trading up here where it's normally between 100 and 200. The idea is that the computers get fooled, and this is more for the computers than for real life traders, because real life traders, we can see that, we can say, yeah, okay, those numbers aren't real. But the idea is that the computers get fooled into thinking that there's actually orders up here, and that will force the market higher. And then as those orders get up here, or as the market gets up here, those orders disappear. So it's actually a form of market manipulation, and it's totally illegal. And yes, the exchanges do watch for that constantly. I do believe one high-frequency trader is sitting in jail right now due to that cute little trick. But that's what spoofing is. And you can see there seems to be a few more orders here on the sell side anyways. Oh, there was a huge order. See that? 400 down here on the buy. So that tells me that there's a lot of traders trying to buy as the market dips. There's a lot of buying support. So here come the sellers now. Oop, the Geiger counter wheel was pulled over hard to the short side and it was holding. And with the Geiger counter, when you're watching the dial here, you're looking for follow through. So let's say see how the dial pulls and it holds and it holds. We really want it to hold for like 3 or 4, even 5 seconds. That tells us there's a lot of pressure one way. And as a result, we would expect some follow through. So let's say, okay, the dial's pulling and holding and holding and holding. That was a fair amount of buying pressure there. Oh, see, it's holding, it's holding, it's holding. We anticipate a follow through now to the upside. So if we're currently long, that's good. We can snuggle in our stops a little bit. We're anticipating the buyers are going to recover the trend from here. If we don't see that follow through in the next few minutes, well, that tells us that all that buying pressure has been absorbed by the sellers and that the market's very likely to start moving the other direction, perhaps here into the hard edge. But that's what the Geiger counter does. So yeah, it's a great resource. So you see, we didn't get that follow through to the upside, so now the market's making a little bit of a dip lower. I do believe I had my stop hit. Yes, I did. So we got tagged there on that little reversal here on the hawk. So nice little first micro macro cross. Not bad for a single. How did we do? Well, that's not bad. We almost doubled our profit objective. Had I gone with the more aggressive parabolics, I probably would have been able to sneak that extra $10 out of there. But that's pretty good for a single. Single contract, nothing wrong with that. And so we've also managed to hit our profit objective here on the Eagle and on the Falcon as well. Like I mentioned before, the Eagle, one of those tools, I don't mind taking an early signal just because the programming behind the Eagle, it's meant to be, to try to pick up a trend. And it looks like we picked up a nice little swing, or at least a swing part there, and it was enough to find our high probability target. Thank goodness. Okay. William asks, can you go over the high probability trades on the Eagle? I'm getting confused on the two bounces. All right. The Eagle, just like the other tools, I think it's important to always bear in mind the context of the market. So you don't just focus on the last 3 bars. You have to take a look at what's been going on before here. And step back from the chart. There's a very famous trader, Ed Sequoia, he's a world famous trader, makes huge amounts of money. He prints off a chart and he puts it on the wall on the other side of his office. That's how far back he gets from the market. Now, to be fair, he can trade with huge stops, which he does. But the point is, he takes a big view of the market and he says, oh, it's going up, or oh, it's going down. He doesn't just focus on the last couple of bars. That's a big mistake. A lot of traders do that. They just focus on the last few bars and they forget to take the whole context of the chart into consideration. So that's step number 1, regardless of which tool you're using. Here what I saw on the Eagle, what this trade had going for it, besides the red bar buy signal, which I'll go over here in a moment, is that we were making higher lows. And that we kind of made a little bit of a higher high here. So there was a very good chance that we would see at least one more move higher, at least high enough to retest the high. All right, so as far as the overall context of this chart goes, market was in a downtrend. There was a very real possibility that this may turn into a bear flag. Remember, a bear flag in a downtrend looks like this, where the trend comes down, you get this little consolidation period. It tends to be a relatively tight little range that pulls back, and then the market reverses and heads lower. Okay. It was a very real possibility that this was a bear flag and that this trade would engage and then reverse and head lower. So for that reason, I incorporated what I refer to as a second push entry. And all a second push entry is, and you can do this on any of the tools, but it seems to occur very often on the Eagle. The signal prints, we're currently against the ATR, so because I'm fearing that maybe this may be nothing more than a bear flag and the market may resume lower, I'm going to at least wait for the market to turn over on the ATR line. So the ATR changes over. This bar right here now effectively becomes our signal bar. You could set up to buy above the high of that signal bar and, cover wherever. What I find with the Eagle, especially with the Eagle, is that very often the signal will engage and then the market is going to flinch. So the next bar traded a little bit higher. So had we placed our entry order right here, we would have been filled. But what happened just after the market traded above that high? It started to drift lower. And then it came up a little bit, and it came down a little bit, and it came up a little bit, and it came down a little bit, and it tried to stay down. And then we started to see a little bit of renewed interest in the market going higher. The whole point of using a second push entry is to find the current limit of the buyers, in this case the buyers because we're looking to buy, and then use that limit to enter our order. Let's take a look at a couple more eagle trades here. Now, not all these were valid signals. This is not a valid signal, but it's a great example of a second push on the entry. Here's a buy signal, and again, it's not a valid buy signal, but just look at what happens. The market engages the signal and reverses. So if I were actually looking to buy here, which I'm not, I could place my entry above the high of this bar. If I were looking to short this signal here, and I'm thinking, you know, the market's come down a long ways, I'm afraid it may go into the hard edge, so I let the signal engage. And you could make a case that this had a second push entry to it, but look at what happens a few bars later. Is there you see the current limit of the sellers. So you can place your entry now below the low of this bar. Now, occasionally the market will run away on you. Occasionally you won't get a second chance to get into the market, but that is rare. So that's a second push entry. It's helpful on the eagle. It's helpful on the falcon. I don't normally use it on the hawk because, of course, the hawk has got a very tight profit objective, so I usually try to get into the hawk a little bit earlier. Now let's go over the high probability signals on the eagle. Well, probably first and foremost is your trend change signal. So once the band flips over, and this is characteristic for all the tools, right? In the hawk, we have the first micro-macro cross. The falcon, we have the trend change signal. The raptor, we have the cloud crossover. The eagle, we've got the trend change signal. So the cloud flips from bullish to bearish. It's the first signal where everything is in sync. Normally, the market will make a little bit of a pullback into the hard edge, and then it will come out and it will produce a sell signal. That's a high probability signal. That's one that you can take with a great deal of confidence. Before we leave here, I'm going to show you the rule of three signal. Now, unfortunately, it's not a perfect rule of three because we've only had two counter trend signals. So we're going to pretend here for a moment and say that there was a third signal. The idea with the rule of three is that we have a bullish bias, and then the market starts producing sell signals against a bullish band. Normally, after the third signal is when we're looking to sell. And of course, the opposite would be true if we had a bearish band. But a rule of three sometimes is only a rule of two. Sometimes it will be a rule of four. So, wrong tool. Sometimes it will be a rule of four where you're going to get four signals against the dominant band, and then you'll be shorting off of the fourth signal. So don't get hung up that you have to have three signals. You don't. I don't consider a rule of one a signal, though. There is no such thing as a rule of one. But a rule of three sometimes only gives you two counter trend signals. A rule of three must always, always, always be preceded by a test of the extreme. All a rule of three is showing you is that the trend is breaking down. So the signal prints right here, I actually wouldn't take this trade until it got below that low. Why? Well, because normally we see three signals break down. I do start to get interested after the second signal, and I may throw an order in there. I'll definitely keep my stop as far away as I can afford, ideally above that high. because there's a chance the market's going to try to do one of these. Maybe give it one more test before it starts to head down. Oops, getting a little sloppy here. And then it will come down here, and then it will produce my third signal. There we go. So it will produce my third signal right here, and now I'm going to get more interested in shorting. I will probably still enter below the low of the three, and I'll try to capture a move lower. Like most of our counter trend signals, you can always use the rule of three simply as an early warning, and you can wait for the trend change signal. Okay, so that's the second high probability signal in the eagle. The third high probability signal, and unfortunately this one failed, although it looks pretty good, is the green bar sell, or in an uptrend, it's the red bar buy. Whenever the market encounters the hard edge, we anticipate some sort of reaction. And you're going to notice here that this nice little retracement, oh, look at that. That looks like a bear flag, doesn't it? So this is practically a textbook green bar sell, and it would have been worth selling. Unfortunately, it didn't have the follow-through. Probably because it was Friday, and probably because the market was closing. So again, context, right? You wouldn't take that trade in the dying minutes on a Friday afternoon. Any other time, that signal probably would have gone at least low enough that you could retest the lows and maybe do something with your stops. But that's a green bar sell signal. So remember, whenever you encounter the hard edge, we're expecting some sort of reaction. Let me see if I can't find you a decent one. Oh, well, here's a red bar buy signal. Now, once the market starts to print signals through the band going the opposite direction, you need to be a little bit suspicious that, hey, maybe this is going to develop into a rule of three. Namely, maybe the market's going to top out and then start to reverse and go the other way. If you think there's enough room from your entry signal to the top of the current swing, then go ahead, go for it. Or, throw in a onesie, so if things don't work out too well, you're not going to get clobbered. But be aware that, once you start printing signals against here, you may be seeing the end of the current trend. Every time the market changes color on these tools, and before I roll this forward, I'm going to show this to you. You have to remember what this is telling you. This is telling you a market that's in a strong uptrend, and then all of a sudden the strong uptrend ran into a brick wall. They get up here to 43.50, they hit 43.55, and all of a sudden the selling pushes the market all the way down here to the hard edge, and so much so that the tool changes from green bars, which are technically overall bullish, even though these solid bars mean that the market is closing below the open. But the market pushes so low that the momentum changes. The color changes from green to red, and now we are getting into a more bearish environment. This seems to wake up the buyers all of a sudden. They've been slacking. And now this becomes the buyer's last chance to recover the market, and that's where we get the red bar buy. Sellers push back, and they actually the conditions in the tool are enough to actually produce a sell signal. Notice we didn't produce a sell signal here, but now all of a sudden we're producing a sell signal. So now you start to wonder who really has control. But like I said, if the logistics are good and you think there's enough room in here to profit or at least tighten your stops before you encounter the highs, then it may be worth trying. And let's say you're going to wait for the ATR to turn over, you're going to risk it down to here, and then the market gets up, and all of a sudden you get one of those bars. Well, you should assume the worst, and you should probably start to roll your stop in a little bit tighter, at the very least below these lows. And then the trade starts to unwind a little bit. Oh, here we go. Here we have a rule of three. Technically 1, 2, 3. We have had a retest of the high. So you could be looking to short here, or you could be looking for the trend change. Again, it's counter trend, so you need to put your stop as far away as you can in case there's one more retest of the high. This is the place where you know you are truly wrong. You don't know if the market takes out this swing high here if you're really wrong, but if it takes out that swing high, yeah, you're definitely wrong. And we get a lot of that sideways action. Another little rule of three scenario, we continue to make lower highs. That's important, right? We're not seeing any aggressive buying. And they really make us sweat this one for a while. Oh, see, there was one more push. Oh, and then it started to unwind the other way, and then we come back with a trend change signal. We did get a chance here to do something with our stops, but you get the idea. Okay, so that's the red bar buy. And that's the green bar sell. So those are your high probability signals on the eagle. I hope I didn't just confuse the heck out of you guys. William asks, is there a rule of three to the left? Left of the current NASDAQ or left of where I was before I moved my chart? Oh, forget it, he says. All right. But like I said, the structure means a lot. The fact that the market has paid off to the upside this morning means a lot. It means I'm going to be more bullish than bearish. Crude oil kind of hitting the brakes a little bit around that 47.80 mark. Here's crude oil now on the hawk. Actually, I guess we only have a few days left on this contract, don't we? So we've got a macro pullback here just prior to crude oil's opening or around crude oil's opening. A nice little rally coming out of that. Another macro pullback. Remember, within a trend, we don't normally see macro pullback after macro pullback after macro pullback. We normally see two within a trend. So after this one, I'm going to start to get a little bit leery. And we might start to see that slowing of the buyer's momentum, at least for the day session. Overall, I do believe that crude oil is still going to be plotting higher. All right, so now the NQ hitting the skids a little bit as the sellers try to take a stand, getting a possible trend change / late filter entry signal here on the Falcon. No signal yet, but you see the filter is out of sync. Oh, there's the warning dot. Trend line remaining in sync, that's very important. All right, well, we'll just put that away for now. Okay, we are getting a late filter entry signal here. This on the Falcon, it's the only tool right now that is against the other tools. The other tools looking bullish. As I've mentioned already, if the market is paying off in one direction, I'm going to tend to favor signals to the upside because the market has paid off that way. Yes, this is a high probability signal. So what I'm going to do is I'm going to dial down my risk amount, and we're going to take a look at doing it like so. Overall, I believe the market's still to be bullish, so I don't want to get too crazy on the sell side. And this is an instance too where I could use a second push entry. So I could have let the order engage, and you see how it's retreating away from the entry signal? That means I could set my sell order below that low right there. That might have been a smart thing to do. Especially since I'm only giving up a few ticks on the entry. And what I'm doing with this signal is I'm purely playing the probabilities. I'm playing the probability of the formation, the late filter entry, that it's going to be at least enough to get to my high probability target. And if I can get this bar to close on the low, I'm going to start to roll my stops up. Why? Well, because you see the big tall wick on this bar? That tells me that the buyers have tried to buy the market up, but the sellers took control of the bar and drove the market back down, assuming it can close on the low and actually form another red bar. At which time I can probably go to a stop strategy like the ATR, bring my stops in above this high instead of this great big swing high. All right, so I'm going to engage those stops now. And we'll see if we can't drift through the primary resistance here. This is going to be a little bit of a trouble spot. Come on. If I can get one more bar lower, then I'm going to roll to this stop here. I don't want to do it yet because it's still within the range. I'm doing my very, very best to be patient with my stops. So you can see the active buying here off the primary support, this 43.33 half, 43.34 area. Buyers trying to push the market a little bit. Crude oil may be getting a little toppy. Again, I don't expect a full-on reversal out of crude. I think you're much safer buying crude right now, but they have gotten very flat. Yeah, William says, my support and resistance suite numbers are off from yours. My chart is set at 24/7. Try changing it to 24/5, William, and see if that doesn't change the settings. Here, I'll show you my settings on the support and resistance suite. Come on, there we go. So the ultimate support and resistance suite, I have, oh, sorry, those are all default. Let's try this again. Data series, this is what I'm after. So I happen to have 30 days of data loaded, and I'm set at 24/5. The 30 days of data shouldn't matter. I do believe the ultimate support and resistance suite needs at least 10 days of data. But if you set it at 24/7, what's going to happen is it's going to take in the Sunday Globex session, and that's going to be enough to mess you up. Okay, our gold trade in the Eagle finally getting some downward momentum to it after drifting sideways for almost the last hour. Finally getting a little bit of a move lower, so things shaping up pretty good for our Eagle trade. You can see with gold, I also doubled the profit objective. So our high probability target is only $200, which would be sitting right down here. We're just hovering above it, and there we go. We hit our high probability target, so don't be afraid to take that money when you have it. All right, we hit the break even. And I'd better get a more aggressive stop in here. I don't want this backing up on me. There we go. In fact, I may be more aggressive still. We'll go with the bar high low. There we go. That's all you're going to get. So there's the gold trade. Prices just hovering above our extended profit objective, and I've got my stops in here in case they try to sneak back to the hard edge. I don't want them backing up on me. Okay, you see how the overall trend, why the market, is moving up, why I chose to go with a smaller amount here. There you go. Because I guarantee somebody's going to write me today and say, hey, Eric, I took that late filter entry signal. You said it's a high probability signal. Why didn't it work out? Well, it didn't work out because the context of the chart was bullish. Unfortunately, it is a high probability signal. Unfortunately, it is worth taking. In this case, it didn't work out. I suppose what I could have done is I could have reduced my profit objective to make it a little bit easier on the market. So taking on the hash mark, cover it up here. See, I could have got a scalp target out of it. But you always need to be wary when taking a counter trend signal, even if it does happen to be a high probability signal. So it was worth trying. Oh, and you know what? Maybe it's going to turn out that my stop was too tight. Maybe I needed to leave my stop back above that high. We'll see if we get a little bit of a double top type thing going on here. Because very often the tools will pick up stuff before you're even aware of it. That's why you need to learn to trust your signals. For those of you trading and you're a little bit tight on funds, let's see if I get it here. Yes, just loading it up now. You may consider, if you're following the stock indices, you may consider trading the SPYDER, SPY. It's the ETF derivative of the E-mini S&P. And you can see here's the hawk on the SPYDER. You produce some nice signals. Some of it can unfold very quickly. You can see this little move here all developed within the matter of a couple of seconds. The market went boop, boop, straight up. But then you had a few minutes to catch this first micro-macro cross. The nice thing about an instrument like the SPYDER is you can trade it all the way down here. And look at that, on a single contract, you're only risking 92 cents. Now, of course, you'd never trade it on a single contract, but the point is that you have greater control over your risk. So if you're trading, say, I don't know, a $5,000 account, this gives you ultimate control over your risk. Whereas in the NASDAQ or the S&P, you'd probably be risking $300, $400 out of your 5,000, which is, pushing 10%, certainly 8% of your risk capital, which is far too high. You can dial this down so that you are only risking $100 or $200 or whatever you deem would be appropriate for your account. 200 might be a little high for a $5,000 account, but certainly 2% of $5,000 is only $100. You can do that on the SPYDER. And what you would also do, of course, is you would enlarge your profit objective. There's no point in trading this for $10. You're going to owe $7 in commissions. So it's not going to be worth it. But you can enlarge your profit objective, and sometimes you can catch some pretty decent moves, right? I would certainly look to get larger profits on these trades. But there's a very real option for you to do that. And like I say, have greater control over your capital. So it's worth investigating if you're trading a very small account. There's also things like the mini crude market. There's the mini gold. You can get mini markets for almost anything nowadays. I'm not a big fan of the micro markets. although I don't have very much experience with them. I almost think the micro markets, you can't earn enough, right? The earnings are so small that unless you have an exceptionally large day or you're holding for several days, you're just not going to see any money out of that. Okay, gold taking a real nosedive here. I guess I shouldn't have been so quick with my stop. The gold market just falling off hard. Here's gold on the Eagle. So I got stopped out right about here, and gold continuing much, much further. Did get comparable signals on the Falcon and the Hawk, so I don't know. Tony, are you watching gold today? If Tony's in the room, I know sometimes he'll catch a nice little move on gold. Oh, Tony says not on gold today. That's probably why it's making those monster moves. Isn't that always the way? When we're not watching it, then it makes that enormous move. William asks, is there a general rule or website regarding when contracts change? Yes, you know, I'm a big believer you may as well go to the source. And hold on, I'm getting you the source right here. So here's the CME group, and you can just type expiration calendar. Nope, that's not the one I wanted. You can also search by the, oh, there it is. A lot of these will be options, of course. We're not necessarily interested in options. Or you can just go to the market you're interested in. So let's say, for instance, crude. And we'll get the contract specs, crude oil contract specs. There we go. And in here, it will have expiration. Okay, don't make a liar out of me. It is here, honest. Oh, these are options. Settlements, there we go. No, shoot, I'm still on the options. It's normally not this hard to find, just when you go to show somebody. All right, let's do it this way. Doggone it, did they change this? It used to say right here, expiration. It would be like the third Friday of the month before the trade at market settlement rules. that's getting annoying. There we go. Let's go to bar chart. There's the CME one. Maybe that's the one I was looking for. Yeah, I'll send you guys feedback, all right. Okay, there we go. So here we are, May 2016. That one's too tough to use. Let's take a look at the bar chart one. There we go. This is more like it. Crude oil, May expires April 20th. June expires May 20th. July expires June 21st. So there we go. We'll give a little plug to barchart.com. That's a much better expiration calendar. I don't know why the CME has made theirs so difficult. It used to be a lot easier. Oh, there's 67 trading events if you want to sift through all those. Oh, here, filter calendar events. That's what we want. We want last trading day and select products. They've made it more interactive, which doesn't necessarily make it easier to use. And we want it for the June contract. Oops, sorry. Oh, I'm not liking, this used to be much easier. The CME calendar used to be very easy to use. That's why I directed you there. But I think, like I said, I'll give a plug here to bar chart, and theirs is pretty straightforward. So you find the contract you're trading, and currently we're on June crude, and it's going to expire at the end of the week. So this will be our last week with crude oil, or in the June contract for crude oil. Wow, that was cumbersome. Yeah, that's true. Jim and Tony are both reminding me you can use the instrument manager as well, and I'll show you how that works here in a second. So what you do is you go to, oops, here we go. You can go here to your instrument manager, and it will always tell you the current month. So if we go here to crude, see how I'm going to click on crude, and then you click this arrow here, and then if you want to put crude back, you click that arrow there, and it's going to give you whatever the current month is. So I've removed it, and now I'm going to put it back, and by default it gives me crude, June crude. But let's see if I've got one here that's going to expire. Took me a long time to figure that out, by the way. No, these are all current months. But that's a very simple way to go through it. The other thing you can do is you can build yourself a little market analyzer. And what the market analyzer does is you can compare markets against each other. Oops, before you do that though, you have to make sure, let's do crude oil for instance. So the next crude contract is going to be July. So we're going to add July crude to our mix. So now we have, oh, where did it go? There we go. There. So now I have June crude and July crude. So what I'm going to do is I'm going to compare June crude with July crude. And you right click on here to add your instrument to get your submenu. Now what I want to do is I want to edit my columns because I don't care so much about the bid and the ask. So we're going to remove that, remove that, remove that. And we're going to find our volume. I forget whether it's average. No, I don't think it's average daily volume. I want daily volume. All right. So technically we want to be trading the most liquid market, and you can see that June crude, even though there's plenty of volume in July, no problem going into the July contract at this stage if you wanted to. There's lots of volume there. But the June contract still has about twice the volume that July has. So that's another way you can do it. Crude oil is one of these markets that's huge. So it doesn't matter whether you're following July or August or even September for that matter, there's going to be lots and lots of volume out there. But yeah, just do a Google search, futures expiration calendar. There's probably even better ones out there than that. Indicator Warehouse has a calendar at the bottom of the web page. So here's Indicator Warehouse. If you roll to the very bottom, they have an economic calendar. So you can see what's going on today. And it will show you, crude oil expiring today, but normally you want to know these things a little bit further in advance. But it's still helpful for knowing if there's any important reports or things of that nature coming out. Whew, I know, that was a little tough, wasn't it? Sure, Jim asked, Eric, take a look at crude oil. You can see a trend line break to the upside that shows it as topping out. Well, let's take a look here at the hawk on crude. And you can probably shoot a big trend line across crude oil like this. And yeah, you're absolutely right, Jim. You can see the market starting to fall apart here. This macro pullback failing. We've got now our retest of the highs. I don't normally short the failure of a macro pullback, but that is an option to you. I don't point it out because I don't want you guys looking at all these counter trend signals. A very good chance that crude oil will come back here now with a first micro-macro cross. Jim says the Raptor is giving a cleaner look on it. So he's going to shoot that over to me. We'll check my email in a second. So still kind of flirting with this double top type scenario here in the NQ. Yeah, I shouldn't get too crazy about shorting. Jim says his long trades are 85% and short trades are only at 37% win ratios. He says, I think it's a long day. Yeah, I think you're right. I think it is a buyer's market today. Darn telemarketers calling during business hours or during trading hours. Shame on them. And they're from a finance group as well. So they know they know I'm trading now. Don't bother me. All right. Well, let's see what we got going on here. Oh, shoot. Looking the other way. I missed the late filter entry signal here on the Falcon. Doggone it. I was checking other charts. Oh, I got to dial this back to 2%. There we go. Now we can take it. So entered the late filter entry signal. Oh, sorry. 1 second here. All right, let's try this again. So late filter entry signal, again, high probability signal. Filter goes out of sync, comes back into sync. Very important. trend line never changes color. We produce a buy signal. And this one is such that there's no point in trying to enter above this high. You may as well take it on the hash mark because you'd be giving up too much open profit to hit your profit objective, and you're working the signal. So not quite to the profit target just yet. We've hit the 43.50 area, which we identified earlier as a little bit of a problem spot. Just going to check my email, see whether Jim's email has come through yet. Oh yes, all right, so here's Jim's Raptor chart. So you can see a nice topping formation. So the market's topping out. Soft edge sell came very late, but it came here at the trend line break. I have a feeling Jim was already shorting from up here somewhere though. So we're looking for crude to, yeah, this is crude. Looking for crude to retrace down here to the hard edge. That would be 47.10-ish. Seems like a plausible target. All right, so the late filter entry to the buy side, nice follow through there, hit the profit objective. Next stop, 43.55. And it's definitely a buyer's market today. Hey, way to go, Tony. Tony says he hit the late filter entry signal here on the NQ. Nicely done. Yeah, I was checking out another chart, and this one slipped past me, but well done. I love it when you guys pick up your own signals. I don't mind pointing out signals to you. That's why I'm here. I'm here to help you learn to identify them, but when you find your own signals, that's even better. So a good day so far. Nice little red bar buy signal here on the Eagle. Is that the one that we took earlier? No, it took this one here. So here was a follow-up red bar buy signal. Don't know how I missed that one. But that also had nice follow-through. This one, again, I would probably wait for the ATR to come into sync. Well, you know what? This is really one where you've got to weigh the benefits of a later entry with taking the hash mark early, because if the market's going to stall, it's going to stall up here. So if I wait for the signal to get all the way through here to flip over the ATR, effectively making this now my signal bar. Look at how close I am to those highs. I'm only like 5-6 ticks off. I have hardly any room to adjust my trade. So even though it's against the ATR, if I took the trade here and say risk it at least below the trend line, I'm halfway to my profit objective when we encounter these highs at 43.46. That means I can probably adjust my stop. I could bring my break even into here. Maybe I'll set my break even to be just shy of 43.46. Oops. So the market engages me, it comes up. See, it was starting to flinch at 43.46. Sellers tried to sell it early. Market came down, tried to go up. Maybe at this bar, I'm going to roll my stop from down here. At the very least to here, if I'm anxious about the trade, if I think it may turn, maybe I'll bring them down to here somewhere. More selling as they try to knock the market down at the highs. All right, now I'm definitely thinking about bringing my stop in. Maybe I'll bring it in below that swing. Oh, although I hit my break-even trigger, didn't I? So I could be at break-even already. And there you go. So it's, to be anticipated that whenever the market hits a resistance area like that, especially a fairly substantial one, you're going to see some sort of reaction. You should prepare for it. And now that we've tagged the secondary resistance line, we're close enough. We hit 43.55.25, haven't hit 43.55 half, but that's close enough. We may see a little bit of a reaction here now. Not enough to make me a full-on seller today. It's definitely a buyer's market, but hey, if prices retreated back here to give us a nice little trend line touch, maybe around the 43, 47, 48 area, that could be worth buying. Hey, way to go, William. William also bagged that late filter entry signal. Nicely done, fellas. All right, you guys, I think we're going to wrap up the room today. And yeah, we'll be back tomorrow. Hopefully we'll have another active day like today if you're going to hang out and trade the rest of the afternoon. I think we could see a little bit of a retracement here. Although, as I mentioned, I would not get too crazy on the short side just yet. It is very much a buyer's market today. All right, we'll catch you tomorrow. Bye for now.